Good morning. Thank you for joining the Gabelli Fund's live webcast series. I'm your host, Chris Matheson, and today we're joined by the Gabelli Gold Fund investment team, including portfolio manager Bryan and gold equities analyst Chris Mancini, for a discussion surrounding the current state of the gold market and how gold equities continue to play an important role in investors' portfolios. Caesar has been at the helm of the Gabelli Gold Fund since 1994. Year to date through 6/24, GLDIX is up 20.7%, outperforming the GDX, GLD, and S&P 500. If you have a question during the presentation at any time, you can enter it at the Q&A box at the bottom of your screen. I'd like to now turn the call over to Caesar.
So I'm Bryan, and today I'm joined by my colleague Chris Mancini, and I'm going to do a little bit of talking. Then he'll come back to me, back to him, and hopefully it'll be not too long, and then we can open up for questions. Next slide, please. So what we want to cover today, very briefly, is an update on the gold price, where the gold mining companies are, talk a little bit about valuations, and then give you a few of our investment examples at the end. This is the gold price over the last 5 years, and we're in a bull market. Technically, there's been a breakout, and I think the next stop is the old high of $1,920, and I would expect the gold price to advance through the old high, which was in September 2011. So we're in a bull market for gold. Next slide, please. So, of course, there are any number of reasons to explain this. I thought I'd just touch literally on just a couple of points. One can talk about this a lot. Just remember, gold is a currency. It's money that can't be printed. So it's just an alternative to the fiat currencies that we all own. So those fiat currencies, really have need to maintain their purchasing power, one, and those who are in charge of managing those currencies need to maintain the market's confidence, and of course, confidence once lost is hard to regain, as we all know. Now, here we just show the Fed balance sheet, a chart that you've all seen many times. Just a couple of things I'd like to highlight. One is that the fragility of the financial system was really exposed in September last year, when the repo market blew up, and the Fed then came in and added cash to the system, about 400 billion of dollars. And of course, that was prior to the explosion in their balance sheet as a result of their reaction, the Fed's reaction to the COVID crisis. Now, the Fed can reduce interest rates, which they've done, to zero, and that's an instrument that the Fed has used most in their history. The Fed can also buy assets, and that really came to the fore in the crisis of 2008. And then third, and what we're seeing now, is really a fusion of monetary and fiscal policy. So the Fed acting in concert really with the administration, with the government, with the fiscal authorities. So now they're expanding, they're buying assets, but they're really expanding their lending activities with equity injected by the Fed. So this is a new activity. They're in a new territory. And the issue is, what are the consequences? Next slide, please. So here's just a chart of the federal deficit as a percent of GDP. Again, we've all seen this over and over again. The point I want to make here is, let's just go back to the wartime era, Second World War, that is, when the debt rose above 100%. What happened in the post-war period was that the Fed capped interest rates, and I think we're going to increasingly here talk about possibly capping rates as well as the purchasing of bonds, but the capping of interest rates as a method alongside hopefully stronger nominal GDP growth, which will allow the deficit as a percent of GDP to decline. So should the Fed do that, that will confirm really for us that real interest rates are going to remain negative. All right, that is a very good, in our opinion, environment for gold. Negative real rates. So just moving on. So that's the sort of gold comments. And of course, we're happy to answer questions. So we think it's a good gold environment. So just moving on to the equities, which is what we invest in. Just a couple of things to highlight. Of course, in terms of second quarter earnings, they will be a bit messy. But let's remember that the gold price is 1,750, and in the second quarter of last year, the gold price was hovering around 1,300. So that's over 30% higher. So the revenue line is going to look a lot better, unadjusted for any production interruptions, which there have been. But remember, a production interruption is production deferred, not lost. So that'll come in. We haven't lost it. And then just a couple of the other comments I'd like to make, which will impact earnings. One is local currency changes. The currencies of many of the locations where the mines are have weakened considerably against US dollar. Now that's turned recently, but on a year-on-year basis, those currencies are weaker. So the gold that those companies are generating is much higher in local currency. That'll help profitability. And then of course, input costs such as oil, is well down on a year-on-year basis. At this point, I'd like to hand over to my colleague, Chris Mancini, who's going to talk a little bit, about the impact and the valuation of gold equities. So we've gone through quite a few slides very quickly. Now we're going to slow down a bit, fewer slides, but more analysis. So Chris, thank you.
Okay, yeah, thanks, Caesar. So quick, what I'd like to say just about, and it kind of speaks to what Caesar was saying also just about negative real rates, is that in a world where almost every industry is showing declining earnings and declining free cash flow, the gold mining industry is showing increasing free cash flow. These are four companies that we're just, kind of highlighting. Barrick and Newmont are the two biggest holdings in the fund. They also happen to be the two biggest gold mining companies in the world. And as you can see, the last year, Newmont's free cash flow per share was 50 cents. This year, we estimate it to be, and these are based on our numbers and the models that I keep, we expect Barrick's free cash flow to be $1.25. So really big increase. In Newmont, you can see again, 100% increase in free cash flow, close to 100% increase in B2. And then there's also Dundee Precious Metals, which is almost a tripling of free cash flow. And the primary reason why Barrick and Newmont are showing these big increases is really just because of the gold price increase, and then also the decline in input costs. Dundee is showing big free cash flow. We initiated a position in Dundee this year. It's showing big free cash flow growth because for those two reasons, and also because it was building a mine last year, and now it's benefiting from the production from that mine. If you just go to the next slide, Chris. So again, these are the same four companies. What we'd like to show here is just that the dividends are also increasing pretty substantially. So 2019 dividends for Barrick, I guess that's not maybe that's a 90% increase in the dividend. Newmont, close to a doubling. And then B2 and Dundee, these are initiations in dividends. And what you can also see, don't have to go back to the last slide, but in contrasting the free cash flow yield relative to the current return, so Newmont had a 7% free cash flow yield, or we expect it to have a 7% free cash flow yield and a 1.8% current return, 1.8% dividend yield. And same thing with B2, around an 8% free cash flow relative to 1% dividend. Dundee, much bigger free cash flow. We expect these dividends, these nominal dividends, to increase at the end of this year if the gold price stays where it is and things are, and the status quo prevails throughout the rest of the year. So the point is, we saw big dividend increases from last year to this year, and then also we expect another round of dividend increases at the end of this year. And again, like contrasting or comparing to what Caesar was saying, in a world where there are negative yielding real rates, we're going to see positive yielding dividends for these gold mining companies, but also increasing dividends. So, and if the gold price is in an increasing trend, what we expect to see is an increasing trend of dividends. So meaning a rising trend of dividends. And we think that that's going to be a very powerful story for gold mining equities going forward, where again, we'll be in a world where it's negative yielding rates, rising gold prices, increasing dividends, and they'll cause the market to be attracted to the gold mining shares. So this is really like the state of the gold mining industry, is lots of tailwinds at the current time, rising dividends, rising income. So next slide, Chris. So yeah, Caesar was just going to talk for a minute then about what we're seeing in terms of the trend in valuations relative to the past.
Yeah. Thanks, Chris. So despite the favorable fundamentals, gold equities are still very inexpensive relative to their history. And we just show one example here, and this is from Scotiabank, gold equities on a price to NAV. So there are other metrics that we could have shown: price to cash flow, or market capitalization for every ounce of gold in the ground. Equities, the gold equities are very cheap relative to their history, and this is because they've disappointed, we believe, for so many years. But there's been a change. There's better free cash generation. A whole new slew of managements have come into place, and of course the gold price is much higher. Also, gold equities are inexpensive relative to bullion. So on the XAU index, or a gold equity price, as a percent of the gold price, gold equities are inexpensive, relative to their long run history. Next slide, please, Chris. Yeah, here we just simply want to remind myself to tell you that the gold stocks are still 50% below their December 2010 high. So the index now is about 120, down 50% from its high. And it's still a very small sector. Obviously, the broad range of investors, don't feel that they need to participate from a size standpoint. But we think this is a very interesting opportunity and a method of providing some financial insurance to a diversified portfolio without shorting anything. As you can see, the XAU index market cap is quite a bit less than JP Morgan, for example. On the next slide, we're going to spend a little bit of time on this. I'm going to hand back to Chris, and he's going to tell you a little bit about our process, and then tie it in with some investment examples, give you an idea of how we think about things when investing in gold equities. Chris.
Okay, yeah, thanks, Caesar. So we've been doing this for a very long time. Caesar's been doing this since the fund was started in 1994, and before that. I've been working with Caesar for around 12 years, and I did, worked on as an analyst before that for a while. So we have a lot of experience. As Caesar said, the sector is not that big, so we know the sector extremely well. We know the managements of all the companies extremely well. They're frequently through New York. We go and visit the companies all the time. We visit the mine sites. We kick the tires. The most important thing that we look for is the asset is the most important thing. So the asset meaning what's the quality of the actual mine. We look for mines that are large, low cost, and long life. And there are other things that we look for in terms of the quality of the mine. So the mine has to have, I kind of say sometimes the 3 Gs. So it's the grade, the geology, and the grade, the geometry, and the geography. So we're looking for things that have a very high percentage of mineralization per ton of rock. The geometry is how it lays in the ground. That shows how easy or hard it'll be to get it out of the ground. And the geography is, where is it in the world? Is it near infrastructure or not? Is it in a jurisdiction that's favorable to mining? And then the second most important thing is the management. Can they get the mine? Can they get the rock and the mineralization out of the ground efficiently? And are they good allocators of capital? Again, in tying all these things together and knowing all the assets, and we think the primary majority of the assets in the world very well, and then knowing the management, we tie these things together to try to come to which are the best companies to mine to own their positions. Okay, couple examples of that. Barrick and Newmont. So these are the 2 largest positions in the fund, and like I said, they're the largest positions. They're also the biggest gold mining companies in the world, and they aren't just the largest positions because they're the biggest companies. They're the largest positions because for very specific reasons. For Barrick did a merger with Randgold. Randgold was the largest position in our fund. Barrick was a very small position. Randgold was the smaller company than Barrick, but it had what we feel is the best management in the world, and CEO Mark Bristow and his team. It owned 3 mines in Africa, which were world-class assets, which we had been to, and then it also had cash on its balance sheet. Barrick had some very good assets. Primarily, its Nevada assets were some of the best in the world. It had issues with its management, and then a lot of management turnover, and then it also had a lot of debt on its balance sheet. So the 2 companies, so it was trading at a discount. Randgold was trading at a little bit of a premium. The 2 companies merged in a nil premium merger of equals. And so we realized the potential there of the 2 companies coming together. The Randgold management took over the management of the combined company, even though it was the smaller company. So Mark Bristow is now the CEO of Barrick. His team is running the assets. When we spoke with Mark, we know him very well. We understood what he was going to do to optimize the Barrick assets. Since then, he's done a great job. The stock has performed very well. And that's why we continue to hold it, because it has great assets, great management, delevered balance sheet, generating free cash flow. Similar story with Newmont. Newmont was a big position and Goldcorp was a small one. Goldcorp had very good assets, but again, they had issues managing the assets and they had too much leverage, so they were undercapitalized. Newmont came in, acquired Goldcorp. Newmont, the Newmont management had come into Newmont, the current Newmont management had come into the company around 2010 when their costs were very high. It's a team that was led by a guy named Gary Goldberg, and the CEO was Tom Palmer. They came in and they optimized all of Newmont's assets and brought costs down. In a program that they called Full Potential. In acquiring Goldcorp, they were able to apply the same methodology to the Goldcorp assets. And we feel that there's still a lot to go for in Newmont as they do optimize the Goldcorp assets using their Full Potential methodology. And we think that it's still due for a re-rating. But again, it's because we knew the Goldcorp assets very well and knew the Newmont management very well that we were comfortable owning the combined company through the deal, and we still like it a lot. Alamos is another one. So Alamos had a single heap leach mine in Mexico, which was generating good free cash flow, but we thought that it was actually somewhat overvalued. So we didn't own Alamos when it was just a heap leach asset in Mexico. Then they did a nil premium merger with Orico, which we owned, which has a great mine in Ontario. And then post that deal, around a year after they did the Arico deal, they did a merger. They actually acquired Richmont at a premium, which we owned. So we didn't own Alamos, but we owned Arico and Richmont. And we realized that Alamos, again, it was a heap leach cash flow mine, cash flow generating mine with cash on its balance sheet. Arico Arico specifically was somewhat undercapitalized. Richmont also was somewhat undercapitalized because they're both single asset companies. So we realized what Alamos could do with its balance sheet and with its management relative to optimizing the Arico and Richmont assets. And so we think that the stock has done very well this year. It's done very well over the past year. We've been adding to the Alamos position, and we think that as the market starts to realize what the full potential is for the Arico and Richmont assets, that the stock will do a lot better. The next one quickly is Teranga. So Teranga, so Randgold owned an asset in Senegal named and in the merger with Barrick, Massawa became non-core. It was just a little bit too small for the big combined Barrick Randgold company. So we knew that it was, likely to be up for sale. And then we also knew that Teranga, which we didn't own, has a mine very close to the Massawa deposit. So in talking with Mark at Barrick and talking with the Teranga management, we knew that there was the potential for Barrick to sell just the Massawa deposit to Teranga, and then Teranga could process the Massawa ore through its currently operating mill, and the Massawa ore is much higher grade than the Teranga mill, and so what would happen is that using the same equipment, so the same trucks and the same mill, you'd be processing higher grade ore at the same cost base. So production would go up, but unit cost per ounce would decline. Now, so that deal did happen. Teranga owns Massawa. They're in the process now of kind of switching production from their old deposits to the Massawa deposit. So we've owned that through prior to the deal, through the deal. The stock's done very well. And we still think that it has a good ways to go once they start actually processing the Massawa ore through the Teranga mill. So again, this is just a flavor of kind of we're in this every day. We've been doing this for a very long time. This is what I do, and it's what Caesar does. And so that's our process. It's knowing everything extremely well, and that's what you get with active management.
Thanks, Chris. As you can see, we're pretty passionate, and we love talking about our holdings. Thanks, Chris. So just very briefly to wrap up, we invest in gold equities on a global basis. We're usually fully invested, and we limit ourselves to the gold equities, not to the gold bullion. Next page, Chris. Here are our top 10 positions. As I said, geographically diversified, and then just as a final page of performance, and then we could go to Q&A. And just in conclusion, thank you so much for your time. I know things are busy at the end of the quarter, and we really appreciate you tuning in to this call. And we'd just like to throw it open. Maybe there's some comments and questions. But of course, Chris and I are available anytime if any of you would like to have a conversation, or if there are any other questions. Thanks so much.
Yep, we have quite a few questions that came in here that were before, and then a couple that were submitted now. The first one is from Larry in Minnesota. Is this rally over, and should this be a short-term trade or an allocation to the metal?
Well, we would say that an allocation to gold should be both to gold bullion, much less volatile, is money. It's not really an investment, and to the gold equities, which of course are a lot more volatile. And I think you really need to understand that the gold stocks can and are extraordinarily volatile, and just to realize that and you know, so you can try and lean against the volatility as you know, as it arises. Thanks. Next.
The next one, can you kind of mentioned this before, but the income potential and the safety of the income that these companies are paying out.
Yeah, Chris, just very quickly.
Yeah, I mean, so right. I mean, in terms of the safety, so the income potential we spoke about, but the safety is that, yeah, like they're, as you can see, the current income is very safe for the companies because their free cash flow yield is much higher than their dividend yield. So so they can pay a lot more than they're currently paying. So and if the gold price declines, it's relatively safe. So it's I think that the income at this point is safe.
Yeah, I mean, just to add, I think Tom Palmer at Newmont has said at 12.50 the dividend is safe, 12.50 gold. Isn't that right, Chris?
Yeah, exactly.
Yeah.
So I mean, so that's the thing. So I mean, it can they have the scope to go higher, and they're safe down to a lower price if the price goes.
Okay, the next one from Steven in Pittsburgh. What potential catalyst will bring general investors' attention and interest back into gold mining companies?
I mean, I think that's performance, and corporate performance and investment performance, and then you know, maybe you know, why.
I think that the dividends will be meaningful. You know, I mean, like I think when the market starts to realize that dividends are increasing, the companies can and do generate free cash flow. For the longest time during the last bull market, they in like 2011, 2010, they weren't really generating a lot of free cash flow and paying dividends, and now they are. And so I think that that'll be something that'll get generalists back involved and back interested.
Next question is from Michael in Alabama. Barrick owns about half of Nova Gold Resources. Do you think this asset is a fraud?
No, well, we're not. I mean, I can take that. I mean, we followed the the Donlin Creek asset for a while. We're not shareholders of Nova Gold, but there's nothing to suggest there's anything to do with fraud.
The next question.
I don't think it's a fraud either.
The next question is, what do you think of SSRM, and do you have a position in it?
Yeah, we do have a position in SS, and we also actually have a position in Alisa Gold, which has a mine in Turkey, and those two companies are on the process of merging. Chris, I don't know if you want to add.
Yeah, I mean, yeah. So big picture on SSR and Alisa is that again, we own both, but I think the question is like, so they're what are they going to do now? Because they are going to generate a lot of free cash flow, the combined company. But what's the story going forward? Is it just like a free cash flow generative vehicle, and that's fine, but it's really not big enough to be just a free cash flow generative vehicle. And then, they have each company has some exploration potential, but not fantastic exploration potential. So they don't have enough exploration potential to drive growth off of the pro forma production base. So I think it's fine, but the question is, how do they, what's the story going to be going forward? What's the strategy of the combined company going to be going forward?
This next question, which do you favor, large cap gold corps or small and mid cap gold corps?
I mean,
well, yeah. Okay.
I was just going to say quickly, because I read that. I think that the answer on that is just that they have different risk profiles. That's something to remember. So typically speaking, the small caps are cheaper, but the large caps are more diversified and less risky. So it's hard to say, like, so in a diversified portfolio, you should have, some of both. The questions are just which ones. I think like that's the best way to answer it. You know what I mean? Because the fund does own, the reason the fund has the fund's biggest positions are in the large cap names is because they're safer and less volatile than the small cap.
I mean, typically, this is Caesar, typically as a bull market develops, the valuation gap between large cap and small caps will narrow. And then typically you'll have some interest in even the exploration and development companies. So, there's a sort of cycle that takes place in this.
Okay, how do you see the performance of royalty companies relative to the miners?
Well, Chris may have something to add, but basically, in a gold equity portfolio, the royalty companies are the nearest you can get to gold, because they have no cost of production, but they get overvalued from time to time. So it's a tremendous business model. We own the royalty companies. We've taken we've reduced somewhat our exposure to the royalty companies on a valuation basis. And of course, as the gold price goes up, the production companies are much more levered on an operating basis, of course.
Okay.
Yeah, I agree.
Okay, the next one's from Brad in Indiana. Are gold futures of the COMEX manipulated to manage the rise of gold? And does the Fed care about the price of gold?
Well, I'm not sure I'm qualified to have an answer to that. I mean, all sorts of things go on in the futures market. We had some stresses in the last few months. I'm just not really an expert. We spend our time talking to managements and trying to figure out what stocks to own on behalf of our clients. In terms of, does the Fed care about gold? I think there have been some comments that suggest that it's something obviously that they look at. I mean, I think a massive drop in the price of gold would signal a deflationary environment, which would not please the Fed. But do they spend a lot of time on gold? I mean, I'm sure not. Remember that the Treasury does own 8,200 tons of gold. So the U.S. government is an owner of gold.
Okay, can you comment on Sibanye-Stillwater?
Oh, Sibanye. Sibanye, took over Stillwater. It's not a holding in the portfolio at the current time, but it's leveraged South African producer that diversified into palladium and platinum. I mean, it's something that we don't own at the moment. Chris, anything?
Yeah, I mean, right. I think, again, from a platinum palladium perspective, just within the fund, it's not something that we've been interested in, just because there's a lot of industrial demand drives the PGM, platinum group metal prices. So it's palladium and platinum are primarily used as auto catalysts. Palladium for gas engines, gasoline, and platinum for diesel. So it's not like a monetary asset really, like gold and silver. And the mines in South Africa have been difficult, and that's part of the reason that the price is so high for palladium now, is because mining has been declining in South Africa. So I don't have an opinion on the stock, but it's not something that we've been focused on for the fund for those reasons.
Hey, can you comment on your sell discipline in the portfolio?
Yeah, I mean, obviously, we structure the portfolio across geographies, market cap, and various other criteria. So the sell discipline is very often due to refocusing the structure of the portfolio between large caps and mid caps. I mean, obviously, this is a tough industry. So we're constantly trying to understand changes in the political landscape. South Africa, for example, the fund had a much bigger exposure to the South African gold miners, and the industry there has really suffered major headwinds, and we've reduced our exposure to the South African gold miners. So there can be operational issues, there can be geopolitical issues, as well as portfolio structure and management reasons as to why we would sell a stock or a holding.
Okay. What do you think it will take to reassure investors of the potential life of the Kirkland Lake Australian mine?
Chris can.
I'll just
Chris
speak
can
about that
talk
quickly.
about the Swan.
So Kirkland Lake is actually, and I think the question also, because I'm reading it here too. It asked about Detour to an extent. So right, that's another one where we owned a relatively small position in Detour. Kirkland Lake, bigger position in very big position in Detour actually. Kirkland acquired Detour for a big premium, and so Kirkland has a mine in Australia called Fosterville, which has it's the highest grade gold mine in the world right now. So it's very low tonnage, but very high grade. So very, very big production of total ounces coming out of the mine, but it has a short life. So it's ounces per year now. Reserves are only around 2 million ounces. So it's like another 3 years. So the question is, can they find more of this very high grade mineralization? It doesn't seem like they're going to be, well, they haven't had success in doing that in the past year and a half. So maybe they will, maybe they won't. I don't think the market's putting a lot of value on their potential to extend the very high grade. But for the next 3 years, at current gold prices, that mine standalone could generate, I guess their all-in cost, they're something like $400 an ounce. So off of a $1,700 gold price, 600,000 ounces, that's like close to $1 billion a year of free cash flow for the next 3 years. So it's a huge cash flow generator for the company. And the real story is, and the question also was Detour. Detour is like a huge bulk tonnage operation in Ontario, and the question, and they've been talking. So again, Detour was somewhat undercapitalized because it was a single asset company. So now Kirkland has a lot of cash, primarily that they've generated from Fosterville. So they're going to deploy that at Detour and try to show that it can grow and be much bigger. So I think over the next year or so, they're going to really demonstrate that on Detour, its potential to be a much bigger mine, which with a much longer mine life, and I think that'll drive the valuation higher on Kirkland.
Can you also comment on Royal Gold?
Royal Gold is a royalty company. Like Caesar said, that's the royalty companies have lower volatility because they don't have operating costs. Royal Gold is our biggest royalty company is Franco, then Franco Nevada, then Wheaton Precious Metals, then I think Royal Gold, and then Osisko Gold Royalties. So Royal Gold it has some very good assets. We like the model, but we think that Franco and Wheaton have been better allocators of capital over time, and they're also trading at more appropriate relative valuations than Royal Gold, given its capital allocation strategy in the past. But we like Royal Gold. It pays a dividend, well capitalized, and should participate in deals going forward, in new royalty deals going forward.
Okay, it looks like we have one last question here. What is the lifespan of Terenga's legacy deposit and the lifespan on Massawa?
So the lifespan is, the issue, like I said, was that they're putting both assets together. So now what it's going to be is the Terenga mine is actually called Sabodala. So Sabodala did have a 10-year life, and now with the Massawa deposit attached to it, it'll have close to a 20-year life because it's both deposits combined.
Yeah, and then Teranga has other assets, mines and projects.
Yeah, it has one other mine that it just built, which is going well, and then it has the potential to build other mines.
Yeah,
and we
thanks.
have one more question. Oh, go ahead, Caesar.
No, that's it. What's the final question?
The final question, how many analysts follow each holding as well as find new purchases for the fund?
Well,
I mean,
it's really Chris and myself at our firm. We're responsible for idea generation, managing the portfolio. But I should say that we're long-term holders. It's a low turnover strategy, and we take a long-term view of our holdings. I don't know, Chris, if there's anything you want to add.
No. I mean, again, it's having done this for so long. I think that we both have a very good understanding of all the holdings, like all the holdings in the sector, and we do. And like, I've been keeping models on these companies, NAV models, on a mine by mine basis for years now, and so every quarter, I make an adjustment to my models based on what happened in the quarter, and we meet with the companies frequently. We go to conferences, so it's really that compounded body of work, which is what we rely on, because we so like for example, we just recently, Caesar and I just spoke morning, and I guess this isn't too much inside information. We bought a stock called El Dorado, which we had owned in the past, but sold, and now we just bought some back. But like, it's kind of like a new idea, but not really, because I've been following it for years and years. You know what I mean? So it's really that, just being able to maintain my knowledge base, and then if something new does come along in terms of like a new project, a new deposit, then incrementally we start to follow that and model it out and get to know it over time. So that's the story. It's really that big knowledge base that we've acquired,
Yeah.
and it's maintaining that over time that leads us to our decisions.
Yeah, I mean, El Dorado, we knew Paul Wright very well, who was the manager. Now there's George Burns. He's had a history at other firms. The chairman of that company was an equity analyst, George Albino. So we've known him for many years. Remember, it takes about 10 years at least for a deposit or for a discovery to become a mine. So there's plenty of traveling and plenty of journey, usually disappointment, before a project becomes a mine. So again, it's not a huge sector. But just in summary, thank you so much for your time. We're very excited about the prospects for the sector, and for our fund. And thank you again.
Once again, thank you for joining the webcast. We hope you have a great rest of your day. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.